Good morning, guys. Welcome to the Wednesday webinar. The official name is the Elliott Wave Wednesday live stream. It's May 29th. Only 3 minutes late. We're getting better. Let me get my headphones on here. Hope you guys are doing well. Got a good show. We got the team with us, Alex and Terry. I'll bring them in a second. Obviously, lots going on in the markets. Inverted yield curves, trade wars, markets finishing on the lows, down in the pre-market. Futures are getting worse as we go here. So lots of good stuff going on. Before we get started here, though, everyone lift their glasses, their coffees. Here's to. Fortunately, we're heading up to Grandma Gordon's, on my mom's side, funeral tomorrow. She lives a good life, 92 years old. Great woman. So heavy hearts this morning, but we knew it was coming. So that's that. Yeah, to business. So let's bring in the team here. We'll lighten things up just a touch. Let me just make sure we've got the questions, comments up. There we go. Good morning, guys. All right, good. So again, hope you guys had a good Memorial Day weekend, and jump right back into some volatile markets here. Let me bring the team in here. Good morning, guys. Alex and Terry.
Good morning, Todd.
How are you doing, man?
Fine, thank you. Sorry for your loss, man. I didn't know that.
Yeah, thanks. No, it's good. It's full life, not too difficult towards the end. She was in Colorado, and she outlived 3 husbands.
Oh my God!
And she was, and at 90, she was looking for a 4th.
Yeah, my grandmother actually died in 104. Can you imagine?
Wow, that's amazing.
Yeah, that's really amazing. Yeah,
amazing.
So
yeah,
I mean, when you are over 85, anything above, it's just a blessing. You know?
Yep. Amen. Make the most of it.
Amen.
Every single day. Carpe diem.
Sure.
So, Terry, good morning. How's the sound over there? Everything okay?
Good. Sorry to hear about your grandmother. I know she was loved. She'll be missed, but it sounds like she had a nice, long, wonderful life.
She did. Yep. Thanks for your well wishes. All's well. Looking forward to seeing the family. So yeah. So it's good. Terry, if you can shift your camera, can you do it a little bit to your right? A little.
Okay.
Just a little towards your right. Perfect. Yeah, that's good. All right, guys, good morning. So listen, let's start with, I'm throwing another one at you guys. I think you'll probably get a chuckle out of this. We're going to start with tweet of the day, tweet of the week, actually. So let me shift the screen over here. Let me do this. Let me pull this down. So this actually goes to you guys, Alex and Terry, and I guess all future guests. This is tweet of the week. This was in a DM, a direct message, which is kind of annoying, as you see here. This is feedback for you, Alex and Terry. 522, webinar terrible. Can't stand all the praise from your guests. Like your ladies on a talk show, just get to it. So I was like, all right, I'll be sure to, make my employees less happy. So anyways, guys, stop. No praise. Criticism, all right? So let's just, now that we got that out of the way.
Somebody is bitter today.
Oh, man. Twitter direct message is an evil.
You can please some of the people some of the time, but you can never please all of the people all the time.
Who said that? Don't say it. Who said that? Put it in the comments below. Who just said what Terry just announced? And we'll come up with a special prize for whoever comes up with that quote, as people are frantically Google searching. All right. So, guys, let's talk about the markets here while you guys are typing in Bob Marley as the answer. Let me just get these comments up here. There we go. Yeah, we'll do. Hey, Lance, what's up, man? Frank, thank you very much. Appreciate that, guys. Yeah, we're good. We're good. All right, so obviously we're getting some volatility here. It's an interesting wave count. For those of you guys didn't, not Mark Twain. It was Bob Marley. Well, that was the originator, right, Terry? Bob Marley?
I'm not sure about that.
Bob
Marley?
Yeah, man. Oh God,
the reggae boss.
If it's Mark Twain, somebody search that on Google. Joe the intern, search that on Google. If it is, I look like a complete idiot, but that's all right. It's not the first time this week. So we have futures down 0.7, and I actually made a switch to the wave count. Donald Trump, P.T. Barnum, here they all come. So I made a change to the wave count. It's quite interesting in here about the triangle. What exactly is happening here in this triangle? We've been sideways for if you look back, the first time we saw this price was January 2018. So you're 16 months into a very sideways market. You've got the S&P that made a slight new high, still leaving in the possibility that this is B. The idea that are we in a C wave decline? Okay, is this pointed 300 points, maybe 250 points lower? That's something that we really have to consider. Let's compare this to the NASDAQ and look at the similar account. NASDAQ did make a new high relative to September 2018. What's making me a little bit more bearish here, as I discussed with the members last night, is if you kind of get inside of this right here, doesn't really argue very well for a triangle. The S&P could be counted as a triangle. The NASDAQ, as I'm showing here, looked more like a second wave. And if that's the case, the coming move should be more directional. Okay, like a third wave. So let me just go back to the S&P here, show you that, before we change the wave count, which is fine, you can certainly see something that kind of resembles a triangle in here. So it would be A, B, C, D, E, ready to break down. If this is in triangle, it can't be in a second wave, so this can't be a third wave. The NASDAQ has been a bit more directional, and with everything that's going on with the trade tariffs, with the trade war, semis are something we're going to talk about. That's something that we really need to work on. Now, Yuri, I see what you're saying. Last time you were looking at the expanded triangle. I absolutely agree. And basically, what's going to have to happen is if this is an expanded triangle, we need to hold. I'm showing you the Dow here. We need to hold, down from about 25,000, down to 23.8. We should be holding the 38, the 50%. If this is B of some kind of larger triangle, we need to hold here. Okay, so let's work off the Dow for now. I think for either wave count, and this is a point that is a key distinction in the wave count, both of them in the near term point lower, and we will act on that. So I want to preface this. Alex and Terry, jump in here anytime here when I start to get off track. But the weekly, let's get off the weekly, get down to the daily, work the Dow for a second. Okay, if this is in fact the Dow count, this must be, probably some kind of fourth wave. It would be 1, 2, 3, 4, 5, 4, C of a flat. Your support really needs to come in like right in this cluster of fib. If that's the case, we can then go up and make a new high, which is potentially D of an expanding triangle. Back to the S&P. In fact, let's work the S&P for now. If this is not a motive wave, if this is not, if this is something that is corrective, I don't think we're going to break this shelf of support around 2,700. If we start breaking 2740, break 2722, this old B wave low, and you could reach as far as 2654 in the S&P, that starts to suggest this is a third wave. And what's happening right now is more than corrective. It's actually motive and ready to make new lows. So I'm starting to think that we might need to get a little bit more bearish. Alex, what are you leaning towards? What are you thinking in this count? And give me your thoughts.
Yeah, definitely. What you are saying on the down, it's kind of corresponding.
Don't agree with me. You can't agree.
No,
with
I'm
me.
not.
Argue
I'm
with
not.
me.
Okay, I'm gonna argue. Okay, so if you look the Russell count,
Yeah,
it's kind of agrees with the Dow. So on the Russell, we have something in the small caps which says we are in a B wave.
yeah.
So we have kind of a division, Nasdaq and S&P points lower, and potentially Dow if they hold these supports, and the Russell points higher.
And that's the thing that's driving me crazy, because the Russell, it's weird. The Russell's the weakest, to your point. The Russell's the weakest, but it's the most bullish wave count. Unless, and I'm totally agreeing with you, unless I've got it wrong, this is not a 3. In fact, this is a 5. If this is a 5, fine, that's a 3, and then we're going to get crushed. Yep. We're going to get crushed.
Yeah, Elliott wave aside, if you remove the wave count, pull all that wave count off of it and look at it, does it look like a head and shoulders pattern to you?
I think
that could be very scary.
What's that?
No, I mean,
back here, you're saying.
Mm-hmm.
No, to me,
yeah.
To me, it looks to me, it looks like an inverted head and shoulder on the upside. On the other hand,
see, the perpetual optimist.
Well, I mean, I just think that's traditional tech. That's why we love Elliott Wave. This is why this is Elliott Wave Wednesday. Is traditional technicals are valid. They pinpoint areas of interest, but I think it's extremely subjective. Again, I always get up on the soapbox. I promise I won't go on, but it's like the 200-day moving average. What do? Do you buy there? Do you sell there? Do you do nothing? Like, what do you do with it? I don't know. And and they say Elliott is subjective. I mean, this is the most objective form of a discretionary form of analysis out there. Let's not get on that topic. But so okay, but just one more argument. This also looks like a 3 wave. I mean, you can argue it's maybe a 5, but on a first look, it looks like a 3 wave move in a Russell down in your orange wave A. Here from the Elliott wave perspective, I will be rather going with your X wave in the S&P and look if these two are going to hold and move the markets on the upside for this another push up. Yeah. I mean, we're gonna know. We're gonna know right here at 1400.
Exactly.
We're gonna know right there. That's your hold zone. If that holds, to Alex's point, and I think he's absolutely correct. If that holds, then this count will not survive. It's probably going to go to, what count am I working? This one right here, where C wave could be, we could do just 100% C versus A relationship at 2742 in the SPX. And then that would allow the rut to trace out the remainder of its flat correction, right?
And Dow as well. So, but here's the point. I don't think it matters, guys. And I'm not even, I'm talking to Alex and Terry here. We still have probably 100 SPX points to go on the downside. We're going to open down whatever 0.62% is. So yes, we're a little late here. But I do think there is room to go, and this is the best case scenario for a correction. Now, we also are tracking another possibility, which that the correction was over back here, and this is just a big wave 2 correction, which the implications here are that we will rally significantly once this correction's over, but the implications are exactly the same for down to 2700. So this count, even though it's super bullish in the long term and then medium to near term, 100 points lower. This count, 100 points lower. This count, 400 points lower. Everything points lower right now. Everything. So I think we need to kind of leverage up. We're still holding our longer term positions in our portfolio. This is our stock-only, non-active account. We've got how much in cash? 26% in cash. Okay, so that's by design. If we start to get evidence that we will move down into that zone, we'll begin kind of dipping our toe. Okay, and that. So, John Lidgate. Okay, thank you, Anise. Appreciate that. All right, guys. So, morning, y'all. All right, guys. So from there, let's take a look at what's doing next. Let's talk about yields. Do you want to switch over there and then we'll segment it? We'll bring you guys in. We got to talk about what's going on in the yield market. TLT's happening. TLT's on the move. 30 years up 0.5%. These things are really big coming off an ABC. We had the possibility that this was an impulsive decline, but it looks to be on the move here. The wave count in the bonds, guys, I don't love doing wave counts in the bond market because I think, it is obviously a manipulated market by the government. It's not a freely traded market. I take everything with kind of a grain of salt. TLT has broken any kind of downtrend resistance that you could draw, however you want to do it. Even if you want to do a parallel here, let's see where resistance comes in. That's broken. Okay, that might come in at about 135 in TLT. So bonds up, yields down. Obviously, they're scaling back any kind of rate hikes. They're going back to rate cuts. The dollar's been extremely quiet. We'll bring Alex in here to talk about the FX market. He's got a great handle on it, Alex and Terry. And, before we do that, the gold market, I've been trying to will gold lower based on this count. I don't think it's happening. Gold is pretty frustrating in here. It's had every opportunity to rally based on fits of volatility in the broader market. Just couldn't. So I'm kind of throwing my hands up in the air and say, all right, sell gold. But the reaction here is not impulsive. It's very corrective. So are we in the final E wave of a triangle that began back in 2016? Once we get the breakthrough 13 and change, then gold could be an amazing move up. Okay. The one thing I'm looking at here to hedge the portfolio, I know a lot of you guys who follow our stock portfolio can't go short. You can buy an inverse ETF. There's a lot of arguments against that because it's not truly tracking. But the one vehicle that I am looking for here for a hedge, for those of you who are looking to buy a stock that could hedge in the event of a downturn, is FXY. Before I tell you what's going on there, let me just bring up the dollar-yen kind of explain what's going on here. So the yen ETF, which is FXY, can be traded. This is dollar-yen, and poor Alex has been trying to keep people awake in the FX market because it's extremely low volatility. But what happens is once FX gets going, it rips. This is the dollar-yen exchange rate. Traditionally, what happens is the dollar will rally and the yen will traditionally sell off in upswinging global equities. The yen usually gets weak against all currencies if risk managers and wealth funds and anyone who hedge funds, anyone who trades FX wants to express their bullish risk, their bullish outlook, they'll be selling the yen. So you can see how tight this dollar-yen exchange rate has gotten here. We have not moved at all. FX doesn't know where to go, and I think it's getting to the point where a move will happen. So if equities were to sell off based on what we're saying, we'd expect to see that dollar sell off against the yen. And if that happens, that means the yen is getting stronger. If you flip that over to the yen ETF, this ETF will trade inverse to what the dollar-yen exchange rate is doing. If you start to break up through 88 in FXY, you could see a major push higher in the yen. That generally signals risk aversion, lower equities, and that also correlates pretty well with TLT as the last instrument.
And gold as well.
And gold, exactly. Yep. So if we just throw TLT on top of that, this is getting a little global macroeconomic on you guys. But if TLT is going up, yields are going down, The U.S. dollar should be getting weaker because the markets aren't looking for as many Fed rate hikes because there's already a massive interest rate differential in the U.S. compared to the rest of the world. So if that's starting to happen, people running into bonds, pushing U.S. yields lower, taking some of the shine off the dollar, and that would push currencies like FXY higher. So the dollar would be selling off against the yen, which means FX goes up. And you can see there is a loose correlation here, okay? So TLT has actually made a high relative to SEP 2017, where if you just kind of push bonds out of the way here, FXY clearly hasn't done that. Okay, so we could be in for quite a catch-up trade here in FXY. Alex, do you want to kind of talk me through? I know we didn't set up screen share on your side just because we're short on time, but where do you want to take us on the FX side?
Yeah, we can look a little bit of dollar index, euro dollar, and dollar yen as well. So we can look some of the dollar index. It's choppy on the upside, and I think also there is several accounts there that we might find a small top a little bit on the upside. So I don't think it's have much room to go. Euro is also have something like from 100 to 200 pips lower potential, and that's it. So effect from the possible Fed rate cut in next two meetings, I think will be start to be priced in fully. And also this corresponds very well with your previous story with yields and dollar yen, gold, and traditionally euro and gold move together in a nice correlation. So I think slowly we are getting a big picture very much aligned for a big risk event soon in a 15 or 20 days or a month ahead.
Okay. All right. Good to know. I didn't launch my FX chart, so unfortunately I didn't walk you guys through. So my fault on that. What's going on with cryptos, Alex and Tara? Are we still pretty much hanging into fourth waves? Anything we need to be alerted on? Any moves coming soon?
Yeah, we did have a big run up here a week and a half ago in Bitcoin, and it carried most of the altcoins with it. It's now in a consolidation phase right now. Bitcoin did push up to a new local high of 8,300 or so. But we still, our primary account has got it forecasted to be in either a flat or a triangle, but we're trying to be optimistic here and looking at the sideways picture. Longer term, later on when this fourth wave correction finishes, we'll have another push higher up, possibly to 10 to 12,000.
Yep.
And beyond that, we'll look for another larger degree of correction, and then subsequently another higher impulsive move coming up. So next year could really be a big one. I know there are pundits out there right now even forecasting 30,000 by the end of this year. I think maybe they were on your CNBC stock draft, so they got the crypto this year. Yeah, that's what the basic pattern is for most of these cryptos. Some of the other ones we follow, like Ripple and Stellar and Litecoin, are playing catch.
Before you go on, sorry, let me just interrupt you. What a nice three-wave move that is right there. And if you start to break, back below 8,300, that just confirms that that's a three-wave move, and you don't want to try to buy that breakout. Have the context that Elliott gives you. Have the knowledge of the duration of wave 2 compared to what could happen in wave 4. Just you can't overemphasize that point enough. The time equality of 4v2 is not till July. So pretty much take the summer off from trading crypto, which is not a good message for our marketing team here at our crypto service, is it? But that's what the market is telling us.
Yeah, it's gone back into being a challenge, and to find any kind of good trades, and you want to be very cautious trying to go short when the momentum is carrying everything upwards. But there are a lot of strong resistance levels that we need to break through as we continue going higher. So those are outlined very well with fib resistance zones as well as just other technical highs and channel indicators. So
Good. Well done, guys. Well done on that. All right, perfect. So one other last thing I wanted to talk about is everyone's talking about the inverted yield curve. So what does that mean? Let's take a look at our friends from Stock Charts, and you guys should be able to see that okay. So what we're looking at here is an overlay, okay, of the S&P and the twos, tens minus twos. So the yield on the 10-year treasuries minus the yield on the 2-year treasuries. And generally, a normally sloping yield curve should be, so if you're looking at a chart this way, it should be shorter term rates are lower, longer term rates are higher. And the idea, hopefully you can see my hands, is banks want to borrow in the short term, lend in the long term, and that difference is called net interest margin, and that's the shape of a healthy sloping yield curve in a healthy economy. What happens is when things get too overheated, short-term rates start to overcome and get higher than long-term rates. That's called a flattening yield curve, and eventually it gets inverted. So it can happen from two ways. Either long-term bonds get very strong and TLT's moving up, as we mentioned, pushing long-term yields lower because TLT represents 20-plus year treasuries, or the Fed is raising rates in the short term. Fed controls the short end of the curve, and it could happen that way as well. What's happening is longer-term yields are getting very weak, creating that inverted yield curve. So those of you who follow the yield curve might know, well, relative height of the yield curve matters as well. There's a lot of schools of thought, and again, they say technicals, and specifically Elliott wave is subjective. But they're like, well, what kind of yield curve inversion is it? Does it matter? So this is the S&P in yellow over the tens minus twos. This yellow line is the white line is clearly labeled below zero as yield curve inversion. So the one thing that you'll notice here is when the red and blue, which is your yield curve, gets below negative, there's usually a pretty good lead time, okay, before a serious stock market event happens. So you can see we went negative a couple times here, 95, 96, 97. That was long-term capital management, Asian currency crisis. There was a lot of stuff that happened before we finally topped out in 2000. So then the yield curve went up. We dropped down here in the credit crisis. We first went negative in, looks like, 05. And, the stock market didn't really top until 07 into the credit crisis. So here we go again. Yield curve inversion is just happened in tens minus twos, but you can just see that, okay, we generally interact with yield curve inversion on tens minus twos for this is a quarterly bar, so for years. We've just started to interact with inversion. What's happening a little bit more, which is a little bit more urgent, is the 3-month, and this is what's making all the news, and it should be in here. There it is. So right now what's happening, this is a daily chart of tens minus 3 months. This is certainly hit negative, right? So you have the zero line right here on this red and blue or red and green kind of line chart. You're starting to see that. This looks a little bit more urgent on the shorter term. You hit negative here in March. Market rallied up to a new high, began to sell off. Again, this is the S&P. So let's go back. Let's go back to a monthly and just see what this kind of looks like. Let's go back even further to the quarterly. Okay. So what you'll see here is this one doesn't spend as much time interacting with inversion. Okay. If you were to just kind of look, when we get inversion, it actually, on the threes, it actually marks the stock market top a little bit more accurately than tens minus twos. So you get a 1, you get just a couple quarters of interaction with inversion here in 07, rally back. Here we go again. We're not quite to the point of inversion that has signaled the last 2 significant recessions, but we're certainly on the way. I think the takeaway here is the wave count that we were looking at in terms of is this a B or next wave correction in the rut in the S&P, that conversation Alex and I were having, it tends to line up with this, that we might still make a new high in the S&P before we get enough interaction with yield curve inversion where the market might be ready for a sustained sell-off. So for everything that I just said, I think this is why with our members today and over the next week, we will be structuring option trades to be on the short side, but for these reasons, I don't think this is a long-term top if you're looking at the yield curve here. Everyone's talking about it. All my friends in CBC are all talking about yield curve inversion, but I think it's the duration of inversion that matters, and so far we're pretty early on. Guys, what do you think? Stuff to add? Insult me, please. Don't praise me.
Alex, you want to talk a little bit about some other forex option? I know Todd didn't pull his forex data up, but we do have a couple of opportunities there. Commodities, especially, are your forte, and commodity prices I know are going through the roof right now. There's a big issue with the Midwest flooding in Kansas, Missouri, Tennessee area, where the corn crops are being grown, and I know a bunch of farmers are not able to get their corn in the ground at a certain date. They're going to have to switch to an alternate crop such as soybean. I know corn prices jumped through the roof. I think Alex, you guys are tracking wheat and stuff. But we also got commodity currencies, right? Like the New Zealand dollar, and that one's the one that's on our radar right now.
Yeah, I mean, actually 2 weeks ago we had the largest, almost record net short position on the corn futures markets. And 2 weeks ago, actually, situation was so bearish because the production fundamentally was, supply was very big. And then suddenly the rains appears in the United States, and we had a kind of a short squeeze, which is rarely seen in history. So prices moved abruptly higher in the last week or two, and they're not still stopping. So
now the data that over 5% of the acreage, the plantable acreage for corn, is not going to get planted this year.
What's that going to do for our whiskey business, guys?
Yeah, I mean, it's gonna increase your cost because this low plantation was not, I think, in the last 40 years in the United States. So also, yeah.
Interesting. Let's stick on the commodity currencies because it just ties into what we're doing on yields, global yields, and equities. If that's okay.
Sure.
Certainly interesting. I just want to pull this story together, talk about a few things on the close, but what commodity crosses are you looking at, Alex and Terry?
I'm looking New Zealand dollar for the moment, and I'm looking also Aussie dollar, but the new input from the Australian bank, Reserve Bank, they're gonna probably reduce rates from 150 now to 0.75 in the next few meetings.
Okay.
So announcements are pretty on a rate cut very soon from Australia. So I think they're including now the type of a prolonged trade war with China, which will reflect the economy in the Australia. So I'm particularly holding now New Zealand dollar because they already cut the rate to 1.5, and they're relatively much smaller economy, and I'm expecting dollar to go lower. So I will avoid Aussie dollar for now, and I will focus on New Zealand US dollar.
Don't discount those yen crosses based on what we're saying, though. I mean, look at
sure. I'm ready for that. I'm ready. I'm looking to short dollar yen. Actually, I just made and we will present that today on the Wednesday webinar for clients. I made the count on the dollar yen, so I already have a shorting levels for dollar yen. So we are ready.
Can you imagine if Aussie yen breaks 72? I mean, this is a 1, 2, 3, 4 coming up on a quintuple low. If you break that, that's going to be a pretty big short push. So what about New Zealand yen, Kiwi yen? And guys, don't, as equity traders, don't discount this. A lot of times the currency markets will move first. Right now it's not. The currency markets are extremely low realized volatility, but generally FX and rates move before commodities and equities, kind of signaling a shift in whatever the global macro risk appetite, if it's positive or negative. FX is way due for a move, and do not discount that. There's been a big move in oil. Dollar Norway is a great one. Oh my God! If Dollar Norway breaks up through 9, holy cow! And that just confirms the weakness in oil. That's a strong looking chart.
One of the ways we got a way to make a combination of what we think is going to be strength in the New Zealand dollar and weakness in oil. I think one of our members suggested it to us. We should play a New Zealand CAD cross and take advantage of both strength in the same direction for that. So that's on our radar.
Interesting. Okay. All right. All right, guys. So that's good. So listen, Terry, will you talk just a little bit about what's going on with MotiveWave, the software we use, some of the features that we have, and we're going to be having a lot of fun stuff on MotiveWave coming up, the Elliott Wave software that we use. Do you mind taking a minute or two?
Yeah, MotiveWave is, they've recently come out with their new 6.0 beta version, and it's got a few new features to it. We're still running the 5.4. Once the beta is released into full press, we'll convert our members over into the new 6.0. But basically, MotiveWave is the premier charting package that Trading Analysis relies on for the most accurate Elliott wave and efficient, I would say, most efficient way of applying the Elliott wave structure and Fibonacci levels to your charts. So we all three of us share in a central database on the cloud. Todd, Alex, and I have edit access to these wave counts. So 24 hours a day, since Alex is in in Europe and Todd and I are in the U.S., we've got coverage nearly around the clock to keep all of these charts updated for you guys. It includes crypto analysis, the stock analysis, as well as forex analysis. And if you're a subscriber to our services and you have a MotiveWave product, you can also subscribe to the repository. And that repository service then allows your MotiveWave workspace.
That is not suppository.
No, not suppository. I'm not that
Please continue. Sorry.
The repository. Anyway, that's where all of our analysis files are stored, and they can be shared live with your MotiveWave workspace. So if you're interested in that, come check us out at tradinganalysis.com. Send us information send us a request at info@tradinganalysis.com, and we'll give you more details on how you can sign up for that service.
Awesome. And as I was going through, I realized I screwed up on not showing the charts on those commodity crosses that we're talking about. So Joe, the intern, is getting caught up on VMix, and he'll be yelling at me soon when I'm talking and not the right screen is up. So just bear with us here, guys. All right, so that's that for now, guys. I think everything is cool. I don't have CNBC this week. Obviously got a busy week. Next couple days with the family coming in, but we are going to work here in just a little bit. Markets open in 3 minutes. Check us out at tradinganalysis.com. Full service in terms of actionable trade alerts, analysis, daily videos, chart rooms, trade desks, real positions, real capital. I trade my real money. We trade our real money every single day. No smoke and mirrors. Full accountability. That's how we roll. If you ever watch any of our videos, just real money, and we're swinging it every day. So come watch us trade, and look forward to more from this show in the future. Guys, thanks so much, Alex and Terry. Throw your questions in here, guys, at the bottom of the video. Put the thumbs up if you enjoyed the comment. Put a comment, question down there. Thumbs up on that video. Let us know you appreciate it. Let us know let YouTube know you're watching it. And yeah, we'll see you guys next week. Business as usual going forward. So, Alex and Terry, thanks. Viewers, thanks, and we'll see you guys soon.
Thanks a lot.
See you
Have
guys.
a good day, guys.
Bye-bye. Yeah.